OPEC. Oil prices rise, gasoline becomes expensive, inflation spreads across the economy. Most people assume this is just the market, supply and demand. But behind the scenes, a group of countries meets regularly and decides how much oil the world will receive. A few decisions in a private meeting room can move trillions of dollars in global markets. This is the hidden power of OPEC, and this is how it shapes the price of energy across the planet. To understand how oil prices move, we must first understand one of the most influential organizations in the global economy, the Organization of the Petroleum Exporting Countries. OPEC was founded in 1960 by 5 countries: Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. At the time, global oil markets were dominated by Western oil companies. These companies controlled production, prices, and distribution. Oil-producing nations had very little influence over the price of the resource beneath their own land. OPEC was created to change that. The goal was simple: coordinate oil production among major exporting countries in order to stabilize prices and increase control over their natural resources. Today, OPEC includes multiple member states across the Middle East, Africa, and South America. Together, these countries control a large portion of the world's known oil reserves. But the real power of OPEC is not just its reserves, it is coordination. In most markets, producers compete against each other. When competition increases, prices often fall. OPEC operates differently. Its members coordinate production levels instead of competing aggressively. This allows them to influence the balance between global supply and demand. And in oil markets, even small changes in supply can dramatically move prices. Because the global economy depends heavily on energy, the oil market is extremely sensitive to production changes. Transportation, manufacturing, agriculture, aviation, and logistics all rely on petroleum products. When supply tightens even slightly, prices can rise rapidly. This is why OPEC meetings are closely watched by traders, economists, governments, and financial markets. During these meetings, ministers from member countries discuss the current state of the oil market. They evaluate global demand, economic growth, geopolitical risks, and production levels. Then they decide whether to increase production, reduce production, or keep output stable. These decisions affect millions of barrels of oil per day, and those barrels determine the price of energy worldwide. In simple terms, OPEC acts like a supply manager for a major portion of the global oil market. But its influence does not come from control alone. It comes from discipline. When member countries collectively reduce production, the global supply tightens. And when supply tightens, prices often rise. This is the fundamental mechanism behind OPEC's influence. By coordinating production levels among major exporters, the organization can shift the balance of supply and demand. And when that balance shifts, oil prices move. The most powerful tool OPEC has is surprisingly simple. It controls how much oil enters the global market. This is done through production quotas. A production quota is essentially a limit placed on how much oil each member country is allowed to produce. If OPEC decides that global oil supply is too high and prices are falling, it can reduce these quotas. This forces member countries to produce fewer barrels of oil. When supply decreases, the market tightens. And when markets tighten, prices usually rise. This mechanism works because the oil market is extremely sensitive to supply disruptions. Even a small reduction of 1 or 2 million barrels per day can move global prices significantly. To understand why, consider the scale of the global oil market. The world consumes roughly 100 million barrels of oil every day. A reduction of just a few million barrels may seem small relative to total consumption. But markets react strongly because oil demand is relatively inelastic in the short term. In other words, people and industries cannot quickly stop using oil. Cars still need gasoline, Planes still need jet fuel. Factories still need energy. So when supply drops, prices adjust quickly. OPEC has used this strategy many times in history. During periods when oil prices collapse due to oversupply, the organization often agrees to coordinated production cuts. These cuts remove barrels from the market. As supply tightens, prices gradually recover. But OPEC can also do the opposite. If oil prices become too high and risk damaging the global economy, the organization can increase production quotas. More supply enters the market, which can push prices downward. This balancing act allows OPEC to influence price stability while also protecting the revenues of oil exporting countries. However, managing this balance is not always easy. Each member country has its own economic needs. Some countries rely heavily on oil revenue to fund their government budgets. When prices fall, these nations may want to produce more oil to compensate for lost income. But if everyone produces more, the global supply increases and prices fall even further. This creates tension within the organization. To maintain influence over the market, OPEC relies on cooperation among its members. And that cooperation is the foundation of its ability to shape global energy prices. Some people believe OPEC no longer has power over oil markets. After all, the global energy landscape has changed dramatically in recent decades. The United States has become one of the largest oil producers in the world thanks to shale production. New technologies have expanded exploration and drilling capabilities. Renewable energy sources are growing. Yet, despite these changes, OPEC continues to play a major role in shaping oil prices. One reason is simple: reserves. Many OPEC countries possess enormous oil reserves that can be produced at relatively low cost. Saudi Arabia alone holds some of the largest and most easily accessible reserves on Earth. This gives OPEC members significant strategic leverage. When prices fall too far, these countries can afford to reduce production temporarily. Higher-cost producers in other regions often struggle to remain profitable during these periods. Another reason OPEC remains influential is its expanded cooperation with other oil-producing nations. In recent years, the organization has formed alliances with non-member producers, including Russia. This broader coalition is often referred to as OPEC+. By coordinating production policies with additional major producers, this group controls an even larger share of global oil supply. That collective influence increases the organization's ability to stabilize or move prices. Financial markets recognize this influence. Oil traders around the world closely monitor OPEC meetings and announcements. Even small signals about future production levels can cause immediate price reactions. Because markets are forward-looking, traders attempt to anticipate future supply before it actually changes. If OPEC signals upcoming production cuts, prices may rise instantly as traders expect tighter supply. If OPEC hints at increasing output, prices can fall in anticipation of greater supply. In this way, OPEC's influence extends beyond physical barrels of oil. It also shapes expectations. And expectations play a major role in financial markets. Ultimately, the global oil market is a complex system involving geopolitics, economics, technology, and energy demand. But at the center of that system, OPEC remains one of the most powerful actors. Not because it controls every barrel of oil, but because coordinated supply decisions can shift the balance of the entire market. Oil markets may look chaotic. Prices rise and fall daily. News headlines constantly shift expectations. But behind much of that volatility lies a simple mechanism. Control the supply, and you influence the price. For decades, OPEC has used that principle to shape the global energy market. And as long as the world runs on oil, its decisions will continue to ripple through the global economy.